With $22.07 billion in revenue, the market still panicked. RTX delivered what looked like a flawless quarter, crushing profit expectations, yet institutional investors aggressively dumped the stock. But does this mean Wall Street is wrong, or is there a hidden value trap about to wipe out their gains? Revenue growth hit 9% year over year, pushing the top line to that $22.07 billion mark. At first glance, stock market analysis calls this a victory, but money managers looked past glossy headlines. They saw beyond the fact that net income growth skyrocketed by 34%. What they found hidden was a powder metal manufacturing anomaly at Pratt and Whitney. This operational hurdle requires accelerated fleet inspections, threatening sudden capital outlays. Look closely at the cash flow statement, where free cash flow surged to $1.31 billion. Free cash flow simply represents the cash generated after paying for operating expenses and capital assets. This translates to a free cash flow growth rate of 65% compared to the prior year. Based on those figures, prior year free cash flow was mathematically just $793 million. With that liquidity entering the treasury, investing strategy suggests management would naturally reward shareholders. Yet the company allocated exactly $0 to share repurchases. For an investor applying fundamental analysis, a mature aerospace giant halting buybacks while generating record cash signals, defensive hoarding ahead of supply disruptions. Relying on one headline metric is dangerously deceptive for your value investing decisions, meaning we must look deep inside the balance sheet to grasp why this sell-off is happening. Accounts receivable build hit a staggering $1.82 billion this quarter. This massive $1.82 billion sum represents recognized sales that have not converted into liquid cash yet. While aerospace involves long procurement cycles, consecutive builds of this magnitude indicate administrative bottlenecks or delayed client payments. Management explicitly warned of rising tariff pressures, even as current operating margins improved to 11.6%. Operating margin measures how much profit a company makes on a dollar of sales after variable costs. They proudly display their safety net, a corporate backlog currently standing at an enormous $271 billion. But practicing fundamental analysis, you must realize this massive $271 billion backlog could transform into a low-margin burden if raw material costs rise faster than regulated contracts allow. Furthermore, the product mix is shifting dangerously. Commercial original equipment volume growth surged by 15% at Collins Aerospace, but management admitted to an unfavorable commercial mix, meaning sales are heavily weighted toward less profitable items that dilute overall corporate profitability. The golden rule for stock market analysis here is that volume-driven growth-sacrificing margin quality is rarely sustainable. Despite this operational turbulence, there is a structural shield, as total dividend payout reached $915 million this quarter. This translates to a robust dividend growth rate of 8.9% over the prior year. Even more reassuring for your investing strategy, the dividend payout ratio is sitting at a secure 44.4%. The dividend payout ratio shows the percentage of earnings paid to shareholders in dividends. For context, prior year revenue was $20.24 billion, proving they expanded the pie to sustain returns. So, why did RTX collapse despite a seemingly perfect quarter? Because true value investing requires seeing the dangerous tension between accounting profits and operational reality. While a 34% net income jump looks phenomenal, unquantified manufacturing liabilities, a buyback halt, and mounting tariff costs are discounting future cash flows. Institutional money managers are forward-looking, pricing in an impending margin squeeze that the broader public missed. This clearly proves the assumed safety of legacy industrials is merely an illusion. You can easily check this reality for yourself in future earnings reports. This unavoidable squeeze will violently reprice these manufacturing giants, punishing any passive portfolio ignoring underlying cash flow reality. And this is the part that most people never reach. Not because the information is hidden, not because you need a finance degree or a Bloomberg terminal or 20 years of experience on a trading floor, because knowing what happened is only half the equation. The half that actually changes your life, the half that separates the people who watch history repeat itself from the people who see it coming, is understanding why it happened. The mechanism underneath, the incentive that was misaligned, the risk that was mispriced, the assumption that felt safe until it wasn't. That is what we just broke down together. And that framework, that way of reading a situation, does not expire when this video ends. It travels with you. Into the next financial video you scroll past on your phone, into the next conversation about whether now is a good time to buy or sell or wait, into the next headline designed to make you feel something before you have had a chance to think anything, into the next decision, big or small, where someone is counting on you not knowing what you now know. Here is the truth that every story we cover on this channel keeps pointing back to. Money does not move randomly. Markets do not collapse randomly. Companies do not fail randomly. People do not end up broke randomly. There's always a logic underneath, always a sequence of decisions, incentives, and miscalculations that, when you see them clearly, make the outcome feel almost inevitable. The tragedy is never the collapse itself. The tragedy is that the signals were there the entire time. Visible, readable, understandable, for anyone who knew what to look for. Whether we are talking about a trillion-dollar empire, a housing market on the brink, or the way a single household manages its monthly budget, the laws of gravity remain the same. You cannot build a skyscraper on a foundation of sand, and you cannot build a future on a foundation of financial illiteracy. That is the only edge that actually matters in the long run. Not a hot stock tip, not perfect market timing, just the ability to read the room before everyone else does. It is about shifting your perspective from being a passenger in the global economy to being someone who can actually read the map. Because when you understand the map, the scary headlines lose their power over you. You realize that most of the noise is just that. Noise, designed to keep you reactive rather than proactive. In the world of finance, the most expensive thing you can own is a closed mind. Most people lose money not because they are unlucky, but because they are operating on outdated maps. They are playing a game where the rules changed 10 years ago, but they are still following the old guidebook. By looking at the specific case study we discussed today, you've essentially just updated your software. You've seen how the gears turn behind the curtain. And once you see the machinery, you can never go back to just believing in the magic trick. The path to real wealth isn't paved with complex algorithms. It's paved with the patience to learn and the courage to act on logic when everyone else is acting on emotion. It's about recognizing that every financial disaster and every massive success is just a human story told through numbers. So if this video sharpened something, if it made one concept click that was blurry before, if it gave you one framework you will carry into a real decision, then you already know what to do next. Take that insight and apply it. Don't let it sit as entertainment. Use it as a lens. The next time you see a company skyrocketing or a market dipping, ask yourself, what is the underlying incentive? Who wins if this continues? Who is carrying the risk that no one is talking about? True financial wisdom isn't about knowing everything. It's about knowing how to think about everything. It's about building a mental fortress that protects your capital and your peace of mind. So hit subscribe so you won't miss what's next and jump straight to the next video, because that could be the very insight you need to get ahead.